All attendees are in listen-only mode.
Hello everyone and welcome to today's exclusive webinar. Today we will be going through Q4's Guide to the Markets and Economy, which will provide us with a snapshot of the current state of the economy and the stock market. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speakers, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we will take some time to go through these. And now I'd like to introduce our guest speaker from JP Morgan, Jack Montague. Jack is the Vice President Client Advisor for JP Morgan Asset Management. Jack has been with JP Morgan Asset Management for 1 year and has for BNY Mellon and Dreyfus funds in California since 2010. Jack brings to us over a decade of investment management expertise. Jack holds his Bachelor of Science in Finance and Management from SUNY Albany and is a Long Island native. Thank you for leading us through this webinar today, Jack, and now I'll turn it over to you.
Thank you, Tori. I appreciate those kind words. And yeah, that's SUNY Albany for the East Coast natives out there, New York native here, and now sitting in a hallway downtown Santa Monica. So if we do have any backup noise or people walking through, please excuse me. My wife gave birth to our first son last night, and it's the quietest place that I could find. So if there are some interruptions, they will be short-lived, so please forgive me for that. So today we are going to discuss a number of things as we go through the Guide to the Markets, which is presented by JP Morgan and our team. But we do realize that you have a lot of choices out there as investors. And I wanted to spend a quick minute as to why JP Morgan and Pensionmark are areas that you would like to focus your attention on, and why our partnership is really appreciated by you, and we appreciate that partnership back. So obviously, JP Morgan is one of the most respected financial institutions in the world, serving institutions, high net worth individuals, financial consultants, and individual investors like yourself for over 100 years. But what do a lot of investors don't know is that JP Morgan has actually been ranked #1 or #2 in net mutual fund flows over the past 3 years. It's a great accolade that we're very proud of, and we are #1 in equity fund flows and #1 in overall flows in a 3-year time frame, ahead of some of the bigger mutual fund asset management competitors and all other advisors sold funds. So why do we have such high accolades and garner this much attention into our investments? It's truly our investment capabilities. The people that we have are worldwide in our investment philosophy. We have over 900 investment professionals located in 35 countries across the globe, and we consider that to be the best varieties in the world. Our products are second to none as well. We have currently over 50 4 and 5-star rated funds by Morningstar, which is important because it allows JP Morgan to provide the depth, breadth of products, which allows us to be much more consultative in our investment theories, and we can focus much more on complexities of markets and provide solutions for investors like yourself. Lastly, of course, is the performance. Over the past 10 years, 90% of all mutual fund assets at JP Morgan have been in the first or second quartile according to their Lipper peer groups. So very strong from the performance standpoint. So what does it mean to you? It means a real commitment to our partners like Pensionmark and to investors like yourselves. The partnership for us means bringing JP Morgan's intellectual capital, resources, and insight into your daily activity and conversation. We have several tools to help you articulate that message. First is our Market Insights program, which is what we're going to be discussing today at some length. This is a tool like the Guide to the Markets to help you explain and have better conversations regarding the market and the global economy. The second major tool is our Retirement Insights platform to help you have more insightful conversations and show our thought leadership on a variety of retirement topics, which Pensionmark will speak to you about at another time. And then lastly is our Portfolio Insights, which is really for advisors and institutions that the analysis that we can bring. So without further ado, I wanted to step into the current presentation. I'm going to have Tori click along for me as my internet here has been sluggish in the hospital. So we're going to start on page 2 and just set the brief agenda for what we hope to discuss today. There's 4 major areas that we are going to be discussing. One is a late recovery warm-up. We're just going to talk about obvious signs for recent pickup in the U.S. economic growth and what it means for investors. Second, we're going to talk about our view on interest rates and when they will reverse course from their downward trend, what it means for fixed income investing. So why not be scared of rising rates? The third thing I want to talk about is the investment implication of a rising dollar. And finally, we would like to address why we still have a substantial overweight to U.S. equities currently. So what impact will growth have? The good news is that U.S. economic growth is picking up and is likely sustained for some time in the future. In addition, higher interest rates support a higher dollar, which sustains the case for being overweight U.S. equities still, and it's important to position portfolios for stronger growth, which we can see on page 17 of the Guide to the Markets. The next slide. So again, this is just a quick snapshot of economic growth and the composition of the GDP output in the United States. This page looks a lot at the economic growth over the last 50 years in the United States, which has averaged, as you can see by that top orange line, 3% over the long run, going back to 1965 in this analysis period. In the second quarter, the economy grew at 4.6% year over year, which was compared to first quarter's negative 2.1% growth. So a real uptick in the short term, and hopefully we'll see that be sustainable. Now, we're likely going to see a pickup in economic growth from this low 2.2% to something closer to the average of 3% if you revert to the and government spending will not be booming, of course, but it will be detracting, not detracting from growth any longer. We've hit the bottom in terms of our austerity. We do expect the Fed to no longer purchase their QE program, their announcements, and of course, we are going to have better growth in real disposable income for the consumer, which we're going to discuss. We're going to have improvement in consumer attitudes. In the last 3 years, we actually estimate that net worth of all American households has actually increased by a whopping 33%, which is outstanding. So one of the main points and takeaways from this slide is very simply you can see the lackluster growth that we've had over the past 6 years as opposed to the average 3% growth. So if you take a look at the other major drawdown, negative reversals of lower than 0% growth, you can see other cyclical bull markets and recovery time periods where the growth expectations far surpass that average of 3%, and levels of euphoria set in, and growth markets were just off to a rocky boom. So the recovery is different this time around. We went through a balance sheet crisis as opposed to a geopolitical crisis or a technical rotation out. So it has taken much longer for economies, countries, and companies to become more efficient in order to generate positive returns, and we will talk about the growth path forecast continue going forward. So on the next slide of page 16 of the Guide to the Markets, you can actually see the cyclical sectors that are the trends for long-term not only economic recoveries, but also the 4 major cyclical sectors that will lead us into recessionary type period. So page 19 of the guide demonstrates how the abundance of pent-up demand will help growth continue and to stay strong. In the top left chart, we can see that auto sales are back up to trend with 16.4 million units in September, and while this is below the 17.4 units in August, a lot of that decline had to do with Labor Day this year and the polar vortex major winter effects that came in the Northeast. The third quarter overall this year was the strongest quarter for auto sales and since the first quarter of 2006. So while we are above trend, we are still far below the historical highs that we've seen over previous peaks of 2008 and back in 2002 period. So Auto sales are recovered, but they're not really going to be the biggest contributor to economic growth going forward. We do think that housing and capital spending are much bigger areas of the economy than auto sales, and both of those areas exhibit plenty of pent-up demand currently today. The lower right chart shows that the 950,000 housing starts in August is well below the 1.35 million average since the 1990s. Capital goods orders have also moved up on the bottom right chart, but in the very long run, they've actually been trending sideways. So again, we know that there is room to grow up in housing, and while capital goods orders are above trend, still once again below the 2 previous peak zones. So we've labeled this a late summer warm-up in economic growth. We're not obviously in the cheap valuations that we were 3 to 5 years ago, but just because the market's come to average valuation, not mean that we should automatically turn on a dime to sell our investments and go try and double down. We do think that the growth will continue, barring some major geopolitical risk or some unforeseen event plays out there. So let's talk about another major area of the economy today, one of the most wildly debated on page 24, which is the unemployment rate here in the United States. So on page 24, we can actually see the extent to pickup in economic growth in the employment numbers, which shows the unemployment rate and payroll unemployment. While most recent unemployment numbers were not released in the time for this guide, as we can tell, because the unemployment rate was reported below the 50-year average at roughly 5.9% in the last reading, most people are still under the impression today that the unemployment rate is above average. However, that's actually not the case. We see this a lot as one of the big misunderstandings of today's economic recovery. If you were to walk into your office or walk into a party with a bunch of friends and ask them generally where they thought the employment rate was in the United States, they would tell you that unemployment still has to be at all-time highs in the United States because it doesn't feel like a real recovery. As much as stock prices are up, economies are doing better, and people are making more money on average, Main Street has not really felt the effects of this recovery until about the past 12 months, in which we start to see an uptick in consumer confidence, and we do expect that to continue down the road as well. So let's talk a little bit more about the labor market on page 25 of the guide. Page 25 of the guide actually will address the reasons why the unemployment rate has continued to tick downward. So the top right chart shows the decline in labor force participation. You can see a drastic decline over the past 20 years in labor force participation. While the decline in labor force participation has contributed to the falling unemployment rate in the U.S., it has also resulted in lower GDP growth and lower payroll employment growth. So it is bringing down unemployment over time, but those people are generally underemployed for part-time and economic reasons, which has created some significant slack in the labor market, which also includes discouraged workers and part-time workers, but we are starting to see those numbers down, as you can see on the top of that chart, from the peak of the 2009 levels right after the financial crisis. So the main point here is that the decline in labor force participation is actually structural in our opinion. The number of baby boomers turning 65 is frankly higher than it was 10 years ago, and it will stay at that high plateau for the years to come as we consider numbers still are, I believe, 10,000 baby boomers are retiring every single day. So the number of Americans with criminal records has also been a big talking point on recent notes, because we all know with the financial fallout that it's much more difficult to become employed, and the automatic quantitative screens that employers are using will generally automatically eliminate anyone with a felony or criminal charge on their record from consideration. So because of the higher levels of criminal records, we will also have a larger number of U.S. civilians that are no longer employable, at least in the short term, until employers start to see some unemployment woes and then start to see a lack of the labor force supply, in which case they need to hire more people, and they will ease up on those standards. Also, wage growth has begun to pick up. It's not growing faster because workers and businesses just don't realize that we're running out of the available workers, as I just mentioned. Wages will not move up faster until people realize that labor is in short supply, which we are going to have problems with. So, there. So let's talk a little bit more about the long-term drivers for economic growth. We touched on the GDP, we've talked on unemployment, but what does the future really look like? And that's what page 22 of the guide is going to show. So page 22 of the guide addresses long-term economic growth. The chart on the right is a graphical depiction of employment, and output per worker over the past 50 years. And output growth has generally been trending around 3% by historical averages, as you can see in that top white box. So this is split into 1.5% growth in the number of workers and 1.5% growth in real GDP per worker. Productivity has slowed to 1.1% the past 10 years, and 1.5% GDP growth per worker is actually very high. We are more likely to see productivity growth going forward, which should take up these numbers at least in the short term, and in the long run will probably trend back around 2.2, which we're going to get into later. So the unemployment rate has come down at a pace of 0.8% per year, and the growth of the labor force itself has only averaged 0.2% so far in the expansion, so very low numbers there. If we continue at the pace we're going, the unemployment rate will be at 5.1% this time next year, which is a phenomenal number, and eventually the reduction in the unemployment rate will stop because of higher inflation concerns, and growth will have to come from growth in the labor force rather than a reduction in unemployment. Very simply stated, the takeaway from this is that companies and countries over the past 5 years have grown their bottom line and their earnings based off of bottom line growth. They would trim their employee headcount, they would optimize their balance sheets, and just become much more efficient engines rather than having to generate top-line revenue growth in order to boost their stock price. So going forward, that can no longer be the case, because once you hit an efficient frontier, you're eventually going to have to sell more goods, manufacture more products, and service them, in which case you're going to have higher productivity per employee. So the long-term drivers, while mixed, still look quite positive over the long term. So let's take a quick kind of sidestep here and move over to interest rates and inflation in the United States. We covered the economy. We do think things that are generally trending higher, and we are heading into this state recovery warm-up. We're not expecting any recession in the near future, while there will be volatility upticks on an intraday, intra-week, and monthly basis. We do expect them to trend higher. So let's go to page 32. 32 is probably my favorite slide in the guide today, because it talks about historical interest rates and where we have been over historical standards. So the right-hand side of 32 on the white box will show that interest rates are at 2.52 on the 10-year Treasury at the time of print. Those numbers have since come down since volatility that we've seen over the past 3 weeks. We're now trending at closer to 1.8, 1.9 on the 10-year Treasury. And once you take out the inflation rate at 1.73, you're really only getting a nominal return on your fixed income yields close to 25 or 30 basis points, which is far different from the September 30th, 1981 peers when you were getting 15.84% on your nominal 10-year Treasury yield. So this, my friends, is an entire generation that has only known fixed income instruments to be existing in a downward trending interest rate environment, which means that they could generate equity-like returns with fixed income-like risk. So everyone who's ever been in a battle or been in the trenches knows that the weapons and the tactics that you use to fight the enemy from an elevated position are far different from those weapons and tactics when you are fighting an uphill battle. So when you hear the major headlines talking about interest rates staying lower for longer and the potential fears and impact that rising rates are going to have on your fixed income investments, and how your portfolio should change over the next 3, 5, 10, 20 investable lifetime, this is the chart that will bring that to life for you. It's going to be a very different environment for the next 30 years. So let's take a look at the Fed and interest rates. Page 35 is a newer slide that we put in the guide to the market. It's only been here for 2 quarters. And it shows the Fed's forecast for growth on the bottom right. So the Fed expects to pick up, growth to pick up to 2.8% in 2015. As you can see in that bottom right box, 2.8% in 2016, and then fall back to 2.2% in the long run. Now, this is an interesting number, however, because their unemployment forecasts have been off throughout this expansion. They predicted the unemployment rate would be 6% in the 4th quarter of 2014, but this number has already hit 5.9%. So the Fed, sorry about that, some passers-by here. So the unemployment rate is currently at 5.9%. So the Fed is calling for unemployment to be at 5.3% by the end of 2016, but we actually disagree with that. So the way that this actually looks, if you have a change in GDP from 2014 year-end to 2.2%, and you have the Fed calling for interest rates at the end of 2015 to have a growth number of 2.8%, that's roughly a 25% expansion in growth in the United States. Now, the unemployment rate, however, if you look at their 6% rate, it's really 5.9 at the end of 2014, and compare that to the 2015 number of 5.5, if you recall from our earlier discussion, the pace or change in unemployment year over year has been closer to 0.8. So they're calling for a 25% expansion in the growth rate, while they're calling for roughly a 40% slowdown in the pace of unemployment. So this is where we think the Fed has gotten the calculation wrong, and this is why Janet Yellen and the Fed have continuously come out and revised their numbers. And when they have their FOMC meetings and congressional hearings, you'll start to hear them say, we may have to raise short-term interest rates sooner than later. Everything is based off of these base case, call it 3-legged stool calculations that they're using. So the Fed has actually pushed up their estimates for interest rates at the end of 2015 and 16. They've changed them consistently towards the higher. So this has an inherent assumption that the Fed would have 5 interest rate hikes in 2015 and 6 interest rate hikes in 2016. And in our opinion, that still may be too slow. So while central banks usually fail to achieve a soft landing in terms of interest rates, they generally have a bad track record of doing it. It is unlikely that the Federal Reserve will achieve a soft landing. The main point here is that we need to prepare as investors for higher interest rates. This does not mean abandoning fixed income altogether, but it means being selective within fixed income and working with your partners at Pensionmark and JP Morgan to come up with a long-term plan that is going to make adjustments, tweaks to your investment allocation accordingly. So let's just take a real-life look at the way that fixed income instruments have returned over the past couple of years. On page 34, you're actually going to see the chart that depicts sources of bond returns. So page 34 of the guide will actually show total returns on different bonds so far this year. You can actually see that on the far right side. So if we look in the short term, 30-year treasuries have achieved a 17.6% return in the first 2 quarters of this year. That is amazing. However, they were down very sharply last year. And if you believe with a more similar experience in 2013 to 2014, what I mean by that is 2013 saw a significant spike in interest rates through May through September of last year when Ben Bernanke just breathed the initial thoughts of tapering our QE program. Investors saw a spike in interest rates to the tune of 1.4% on the 10-year Treasury within that 5-month period, and the average bond fund was down significantly, as opposed to 2014, where a lot of people have gotten all along, and interest rates are actually lower to start the year and where they are today when we started. So basically what it means is that people still need to be diversified across fixed income. There is no crystal ball that's going to tell us where to be, but if our long-term assumptions are correct, there are still going to be opportunities in high yield, emerging market debt, and floating rate instruments. And there also will be opportunities in multi-asset solutions, such as dividend-paying stocks, REITs, preferreds, restrained real-life capital gains. So we all just need to adjust our expectations due to the fact that interest rates are more likely to rise. However, a lot of the fears are unjustified, and page 18 addresses why higher rates will actually not kill consumer spending. We're going to talk about the housing market, and also talk about the debt deficit as well. So on page 18, we can actually see the breakdown of consumer finance. Page 18 demonstrates how households have more money today than practically ever. The total liabilities of American consumers on the top left chart is roughly at 13.9, where it's going to cost $14 trillion, whereas total assets equal in the average household, not the average household, total about $95 trillion. So this is roughly a 6 times assets to liability assumption. So the consumer itself is in a very strong position. You can actually see that on the top right, the total household debt service ratio, so the amount of your paycheck that goes to paying off credit cards, paying off loans, paying off any liabilities that you have outstanding, has come down from the fourth quarter of 2007 from 13.2% to 9.9%. Because again, as companies have become more efficient, trimming their bottom line costs, the consumers have done so as well, as they've had to flight to safety with all of the risks that we've seen in the past 5 years. Next, we're going to talk about the residential real estate market. Excuse me. On page 20, the residential real estate is a very hot topic, especially if you live on one of the coasts today. We see a lot of international buyers and home prices recovering at incredible rates. And the right-hand chart actually shows that in the last 40 years, the average household spent roughly 20.4% of its income on its average mortgage payment for the average home. Now, in the past August reading, that number was down 7% to 13.5%. So consumers with those considerable number of assets on their books are paying a less amount of money every single month out of their pocket to housing across the board. So the affordability of housing is extremely good right now. In other words, in terms of what the impact of rising rates would have to be, you would have to push up rates roughly 50% from where they are currently today to get back to average levels of affordability. So, for example, if a 30-year mortgage would have to be pushed up current levels to a whopping, current levels are roughly 4.2%, and they need to go up to 6.5% again on the average 30-year mortgage in order to get us back to that average affordability index. So rising interest rates is not going to have a negative impact on the residential real estate market because the consumer is in good health and the affordability index is still very low. Now the problem that we have, and the problem that a lot of people are having right now as we're trying to refinance, is actually shown on page 37 of the guide, because it talks about the credit conditions. So it's not so much housing affordability as it is loan affordability. So page 37 is going to take a deeper dive into the issue of mortgage affordability. So some of you may have even seen the headlines that former Fed Chairman Ben Bernanke admitted himself having difficulty refinancing his mortgage because he couldn't prove his income and all of the stringent standards that go into getting refinancing a origination first-time mortgage. So the right-hand chart on page 37 shows that the average FICO score for approved home loans today is 743. So that's not as high as it was, again, 2010, kind of 2011 levels, where we saw mortgages basically just zero length. As you can see in the bottom left chart, loan growth, the orange bar shows real estate loans, and that trend line is basically at 2.9%, which is very, very low. Hasn't gone negative like we saw in the financial crisis, but still banks are making basically no money on these loans. So what would actually happen is if financial institutions saw rising interest rates, they would actually be able to charge more for their mortgages, hence making them more profitable. The higher profit margins that big financial institutions would have would actually allow them to ease up on some of their credit loan obligations. So rising interest rates will actually have better credit conditions for people looking for the first time just going forward. So what next? Let's continue on to page 23. Page 23 talks about federal finances. So one of the major concerns is that rising interest rates would blow up the federal deficit. And page 23 on the far right actually shows the Congressional Budget Office's forecast for the federal deficit and debt through the next decade. So on the top right chart, you can see the line today broken down to 2014 and the forecast going forward. So what we have is in August CBO publication, most recent one that's just come out, the budget highlights why rising rates will not lead to an explosion of the federal debt. Now, the CBO is actually assuming that the 10-year Treasury yield of 4.7%, again, we're roughly 1.8, 1.9 today, between the years 2018 and 2024. So this assumes that long-term rates are going to go back up at least as much as the market right now. So even if that happens, we will still have manageable levels of debt, barring any big changes in terms of spending or revenue inside of the federal finance. So rising rates, I hope that was a brief explanation. I feel confident as to why it's not going to hurt so much for consumers. It's not going to really deteriorate the residential real estate market, and it, of course, is not our expectation. But Fed's forecast not going to blow up our federal deficit. Now, where it actually will be a positive for rising rates is actually going to be in the equity market. So page 12 will show the interest rate equities correlation between weekly stock returns and interest rate movements. So this chart will really show why we don't think rising rates are going to hurt the stock market, contrary to public opinion. We show the relationship here between stock prices and interest rates, where an increase in rates is actually positively correlated with an increase in stock prices when rates are starting at low levels. So when interest rates start at high levels and go higher, you get a negative relationship that's in the bottom right-hand chart, portion of the chart, between interest rates and stock prices. Right now we're at 1.8, 1.9, which is very close to the far left of this chart, and we'll put the correlation in the top left quadrant for higher correlation. So essentially what this correlation chart shows is that when interest rates go up, there is a high correlation or relationship between higher equity returns in the beginning part of the move. Generally, higher interest rates will have an assumption that the economy is doing better, which means investors are more prone to take on risk assets, a la equity. Now you can see that there's a bright orange line driven right through the center of this chart, and that is essentially a break-even point. So in the beginning part of an interest rate hike cycle, which is where we are today, equities do well. Once interest rates come to about 5%, you can actually start to see a negative correlation. And that is very simply addressed because investors at 5% CP rates and short-term fixed instruments will have to start looking for risk-adjusted returns where they want to optimize their risk levels for the current levels that they are contending today. So very interesting chart, and again, rising rates in the beginning part of the market cycle will have a very generous upward correlation. So let's talk about the U.S. dollar. Obviously, you can't talk about a stronger U.S. economy relative to the world we're living in and not have some implications for currencies. So page 28 of the guide actually shows the increase in the U.S. dollar on the far right. The index is at 81 at the end of September. And again, nowhere near the peaks that we saw back in 2000, 2002, north of 110. So this is likely a result of stronger U.S. growth and higher U.S. interest rate projections going forward. So what does a rising dollar do, you may ask? It may actually have negative implications for foreign investing or companies that have big blue chip multinational revenues coming from outside of our borders, because to invest in U.S. dollar goods, it's going to cost them more money, at least in the short run. So you have to look to the global equity markets on page 42. Page 42 just shows a variety of equity instruments, a variety of countries that you may invest in, and you can actually see where the opportunity may lie. So on the top right chart, the weights in the MSCI All Country World Index and the percent of global market capitalization is roughly that 50% of the investable universe for equities is located in the United States. That's a great number. But if you're not looking outside of our borders for investment opportunities, you are foregoing the other 50% of opportunities that are out there. So there's no such thing as easy money, but there are such things as bluer ocean. And outside of the United States, a lot of the countries, large markets that we're looking at are trading at lower valuation and are going through periods of lowering interest rates as opposed to rising rates here in the United States. The European Central Bank and the Bank of Japan are the two most notable, where they are projecting that they are going to be lowering interest rates in the near future as they go through some structural and systemic problems, as opposed to investing in the United States, which we know the direction will trend higher moving forward. So it's all about going to where the money can be. So the Consumer Price Index is the major index for inflation on page 27 of the guide. Now, while a lot of investors are concerned that inflation will pick up, a rising dollar will actually cut a few important prices for us. We do think it will eventually rise, but not quite soon. So a rising dollar tends to cut oil and gas prices, and to the consumers in the United States, which are particularly sensitive to this is a good thing. So if you've seen the oil prices at your local gas station come down considerably over the past 6 months, the rising dollar has actually had a big impact on those prices. So if a rising dollar reduces inflation pressures, it's unlikely that inflation is going to pick up to 2% this year, and it will also increase disposable income for consumers because, again, if you're paying less at the pump, it's going to leave more change in your pocket to go out there and buy some goodies for the family. So let's move forward. Just for sake of time, I do want to get to some questions at the end here. We can talk about the manufacturing momentum on page 44. So when you have a rising dollar, multinational companies become less competitive because other foreign investors will look to garner those products, services, goods from cheaper areas of the globe to save on costs. So as you can see today, the U.S., which is second from the top line, you see a lot of green in those numbers. We're actually putting out a PMI today, which is roughly 57.1, which is actually quite high, and we hope that continues going forward. What you'll also note is that there is also no solidly red numbers in the September column from a variety of sample set countries, both developed international and emerging markets that we've seen below. So a rising dollar is actually good for the global economy because the U.S. is capacity constrained. The U.S. can only go another year or two pushing the unemployment rate down, pushing inflation up, and running out of capacity. A higher dollar will actually take the U.S. demand and bring it overseas. So the U.S. can buy foreign assets and other nations have the capacity to produce it. So we have more money in our pockets. We can spend it outside of our borders, which should, of course, boost GDP for a lot of other countries as the U.S. consumers look to buy goods is cheaper as well. This is a good example of the reverse of what happened over the past, call it, 6 years, when we start to see a lot of international consumers taking holidays, flying to New York, to San Francisco, to Los Angeles, and buying a ton of high-end goods because the euro was that much stronger than the dollar. So essentially, it was cheaper for them to fly here to buy something than to just go buy it in their home country, and the reverse is what's going to go forward if the dollar continues to trend higher. So the key takeaway is that investors should not give up on global growth. The reason it's been so slow this year is mostly because of exchange rate, which will not last forever. And while we are under the impression that the world is in turmoil, the world is actually growing. So usually you only see bad news overseas. That's just media. There's actually a lot of opportunities that are happening, which will be shown on page 51 of the guide. We'll actually show international equity earnings and valuations. So if we look at page 51 of the guide, which shows earnings per share of the U.S., the European, and the emerging market countries, the U.S. is at an all-time high. In contrast, Europe and emerging market companies are still well below their prior peak. So this is likely due to a slowdown in China and the second recession that we're seeing in Europe, maybe a triple-dip recession there. But valuations in Europe have gone up along with the U.S., but they're still lower in emerging markets, which is what you'll see on the far right chart. So the top gray bar, if you will, is the United States forward earnings, forward PE, excuse me. The purple bar is the MSCI Europe, which is also growing at a steady pace, lots of opportunities there, and emerging markets, but while trending sideways, currently still trending slightly towards the upside. So it just means that there is room for growth, particularly in emerging markets, as we do see cheaper valuations, but also to some extent still in Europe. So faster growth will in turn support higher PE ratios, which again, it's the more ocean to expand your investment set to outside of our borders. So let's just talk quickly about the active overweight that we have currently to U.S. equities still. On page 8, we're going to talk about corporate profits and leverage. So with another spectacular earnings season behind us, page 8 of the guide will actually show how we are poised for another one. Based on early analyst estimates, we are expecting another double-digit year in year-over-year gain in operating earnings. You can see on the top left chart, the second quarter earnings numbers were at 29.45. We expect those to grow at roughly 8% going forward. And the profit margins on the top right chart are still trending at all-time highs, roughly the S&P 500 operating earnings per share as a percentage of sales per share. The third quarter of 14 are at 10.1%, an outstanding number. So long-term, we'll probably tend to see these profit margins come down. Very simply, it comes down to the fact that the way companies have hired employees, the slack you mentioned up early, is that the people took a lot of jobs for part-time work, essentially being underpaid just so they can have that income at all. So companies have been getting away with lower wage growth. But as we see the economy pick up and we start to see labor supply demand pick up, we're also going to have to pay those workers more money, which should have a decreased profitability margin within. So good numbers. Then on the bottom right-hand chart, you'll actually see the overall leverage within U.S. companies today also trending at all times. Companies are not building all-time record levels of cash through leverage. They're doing safe, sound investments from good investors. So continuing on, we're going to talk very simply about the stock valuations in the United States. We're going to use the S&P 500 as our base index. So valuations still look quite fair in absolute terms and do look attractive relative to inflation and other interest rate type instruments. So if you take a look at just the top chart here, the PE ratio, the latest reading is 15.3 times. And if you go out to the 25-year average of 15.6, we're right in line with hitting the average valuation in the U.S. So room to start getting a little cautious, but certainly not room to start saying, hey, we need to get out of equity, try and find methods. We do think equity should have an active, slight overweight client portfolios because of the S&P 500's earnings yield versus a bond AA bond yield on the bottom right-hand chart. So this is just a quick analysis of the assumed returns that you can generate in the S&P 500 or the Moody's BAA yield. So the returns for the equity markets are seen at 6.6% versus the fixed income return of 4.8%. So on a relative basis, all we're saying here is that equities are still attractive to the tune of 6% versus fixed income instruments, and that will trend higher as prices go up. American investors change their sentiment to traditional fixed income. So here's a cool chart on page 11 to kind of highlight our thoughts on this. Page 11 actually highlights what happens when bull markets reach fair value. In 5 out of the past 7 bull markets on the left-hand side, we've actually seen that equities have moved upward even after reaching their fair value. So the way you would read this is that the gray bar chart is the returns coming out of a cyclical trough, and those returns on the equity markets getting back to average valuation, back to that 15.6 long-term average that we've seen. Doesn't always have to be 15.6, but again, it's just getting to the levels, and then the light blue bars are the returns that equity investors on the S&P 500 saw in abundance after we've reached average valuation. So while investors feel comfortable investing in markets that are moving up to fair value, because people like to buy what's cheap, as we all do, they often fear moving beyond their fair value, like in other cases. So it's likely that this bull market will overshoot, as again, countries, economies have just been trimming the bottom line costs. We're just starting to see top line revenue growth be earnings and return. So lots of room to potentially run here. You can see we don't expect things to happen like they did in the 1990s, the tech bubble, where we got a 180% return, and then we overshot those returns by an additional 83%. But even in the other 4 that we've seen go higher, CP5, still very healthy returns. So let's talk about cash accounts, just as a point of reference. Here we can see the companies are still flush with cash. We show the companies now have $11 trillion, a huge number, on their balance sheets, ready to be put back into the system. So earnings growth, valuations, momentum, cash levels all support an overweight U.S. equities currently. So traditionally we see cash being deployed within U.S. companies in 3 different ways. One is you can introduce a dividend or increase your current dividend, which is a thing that we do like here at JP Morgan. You can do share repurchase or share buyback programs to take your stock out of, more stock you take out of circulation, the more demand you create based on the supply chain, which drive prices higher. And last but not least, you can kickstart or also introduce M&A markets, which we start to see a ton of headlines today going forward. So the M&A numbers on a dollar side is actually up to 2007 levels, which was the all-time peak that we've seen for M&A activity in those markets. So we're going to finish with just the asset class returns. So finally on page 58 shows all asset classes returns, including cash, which is essentially zero ranked. So once investors understand where the global economy is going, they can understand the risks and opportunities that are out there. And the key takeaway of this slide is that when cash pays you nothing, get invested in something. So we would recommend a long-term diversified portfolio that should be underweight cash. You don't have to take on the volatility of trying to time the market. And the middle chart will show that if you build a long-term financial plan with a variety of mixed asset classes, you will not only generate healthy returns, but you will also stymie the inherent volatility that markets will have. So that's where I'm going to wrap up my comments, Tori. Would love to answer any questions that anyone may have, and we'll turn it over to you, Tori.
Thank you, Jack. We will now go ahead and start addressing some of the questions that have been filtering in. And please, audience, remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. Our first question is, what creates the rise and fall of interest rates?
The rise and fall in interest rates is based on supply and demand. So it's a very good question. Essentially, when you have people or companies that are flush with cash, you will either issue a debt instrument based upon an underlying rating agency that will forecast your availability to pay back that debt. So if you have a company like a, call it a small cap company, an unknown, not a blue chip or a Coca-Cola, that needs to raise financing for a new project and they want to put out a bond issuance, Moody's or one of the big rating agencies will come in, they will kick the tires, understand your finances, understand your balance sheet, and they will continue to put a rating that says the stock should pay X interest rate back to investors to make sure that you are going to be able to pay back. So that is a risk reward you're getting from the credit side based upon your availability to pay back the investors. You're either going to have a higher or lower interest rate on your credit debt. When it comes to governments and the Fed, for example, that is going to be based off of inflation determinants. So that is going to be using, again, the three-legged stool that we saw of GDP growth. It's going to use employment today, and it's going to use inflation to essentially keep the economy on an even keel. If interest rates stay too low for too long, investors will take on far too much risk, and companies won't be able to, through inflation, price their investments or price their goods and services any higher. So when that happens, too much risk in the markets generally creates bubbles. When you have a bubble in any asset class, you would eventually have some type of major sell-off. So interest rates are driven depending on whether you're in a credit environment for a company or from a government is going to be based on economic growth in the future of where the global economy is headed. So.
Thank you, Jack. Our next question is, what can you say about the drop in the market a couple of weeks ago? Was that all due to international affairs?
Yes and no. Yes and no. So the drop in the markets was attributed to any number of issues. One of the major issues was, of course, the fears out of the Eurozone. Europe has had a number of problems coming out of their economic recovery, whether it be higher unemployment rates throughout the Eurozone, whether we continue to see a weakening euro continue to be an issue. And one of the major problems that we saw 2 weeks ago that kind of was catalyst for the sell-off markets was based upon Germany's manufacturing numbers. So when you saw Germany, which is supposed to be the stalwart backbone of the European economy, start to come off a little sluggish, show a little bit of weakness, it spooked a lot of investors, especially in the bond market, to say, is the United States going to be able to, call it, be the new trend leader? Is the United States going to be able to withstand shocks to the global system like we saw in 2008? Didn't matter if you were in U.S. or international, everything went down with a correlation of 1. So the fears that came out of the Eurozone certainly spooked a lot of investors and moved them back into more risk-off assets, which saw interest rates continue to climb from roughly 2.2 down to a whopping 1.8, 1.9 where we are today. So yes, Europe markets certainly were a driving force in the markets over the past couple weeks. And then, of course, there were some additional tag-ons to that, which included geopolitical risks, like we've been seeing out of the Middle East and ISIS. And also, there are some concerns over what Russia is going to be doing to oil distribution within the European areas as we head into the winter months, as Europe is the largest importer of oil from Russia. So it had something to do with all of the above. European valuations, it had to do with geopolitical risks, it had to do with commodity resources.
Thank you, Jack. And it would appear that there are no more questions at this time, so we will conclude this webinar session. Please feel free to reach out to your dedicated Pensionmark service team at 888-201-5488 or info@pensionmark.com. Thank you, Jack, and thank you, attendees, for your participation. I hope you all have a great day, and happy Halloween.
Thank you, everyone. Take care.